Chapter 1. Investment versus Speculation. Investment and speculation may look similar from the outside, but Benjamin Graham explains that they are entirely different in purpose, mindset, and long-term results.
He defines an investment as something purchased after careful study with the expectation of safe and satisfactory returns over time.
Speculation, on the other hand, is driven by guesses, emotions, and the hope of quick profits without solid analysis supporting the decision. Graham states that the biggest danger is when people confuse speculation with investing, thinking they are being rational when they are actually gambling. He warns that speculative behavior often appears intelligent at first, especially when markets rise quickly, giving beginners a false sense of skill. But sooner or later, the market shifts, exposing how fragile speculative strategies truly are. Graham emphasizes that true investing requires discipline, patience, and reliance on facts, not emotions, predictions, or rumors.
He encourages investors to know exactly when they are investing and when they are speculating, so they can control the risk instead of being controlled by it.
Speculation is acceptable only if kept in a small, limited portion of one's total money, almost like entertainment spending.
Graham explains that it is dangerous to let emotions influence decisions because markets often act irrationally in the short term.
He stresses that intelligent investors avoid trying to predict the future and instead focus on analyzing what they can actually know and measure.
A key idea is that speculation becomes harmful only when it is disguised as investing, when people overestimate their knowledge and underestimate risk.
Graham concludes the chapter by stating that the greatest safeguard in the financial world is self-awareness, knowing why you're buying, what you expect, and how much risk you are willing to handle. He teaches that separating investment from speculation is the foundation of financial intelligence, and without this clarity, long-term success is impossible. Chapter 2. Investor and Inflation. Inflation is presented as one of the most powerful forces that silently reduces the real value of money over time. It eats away purchasing power so slowly that many people fail to notice the long-term damage it causes.
The chapter explains that inflation does not always remain high, but even modest inflation, when repeated year after year, can make savings shrink in real terms. It emphasizes how a rupee that once bought a good amount of goods can buy far less a decade later.
Fixed income investments, such as traditional bonds or savings accounts, struggle the most in an inflationary world because their returns remain constant while prices rise. A fixed interest rate may appear safe, but in reality, it often loses purchasing power over time.
The chapter shows examples where long-term government bonds performed poorly once inflation surged, even though they were originally considered risk-free. This highlights how safety can become unsafe when inflation climbs unexpectedly.
Equities or common stocks are described as offering better long-term protection, but they are not perfect shields either. Stocks have historically outpaced inflation across long periods, but their short-term behavior can be unpredictable, especially during economic shocks. The chapter adds that even when companies raise prices to match inflation, profits do not automatically rise because their costs often increase as well. Investors cannot assume stocks will always keep up with inflation smoothly. Real estate and other physical assets may help protect purchasing power, but they also come with uncertainties such as maintenance costs, market cycles, and taxation. No single asset class is a guaranteed inflation solution. The chapter reminds investors that predicting inflation accurately is nearly impossible. Economic forecasts often fail, and long-term projections can be entirely wrong. This uncertainty requires investors to focus on resilience rather than prediction.
A wise investor diversifies rather than depending on a single asset to fight inflation. Combining equities, bonds, and other assets creates a balanced strategy that can weather different inflation environments.
The chapter concludes with the message that inflation is a permanent challenge, not a temporary event. The goal is not to defeat inflation perfectly, but to adopt an investment approach strong enough to survive it over decades.
Chapter 3. A Century of Stock Market History. The chapter explores how the stock market has behaved over more than 100 years, revealing clear patterns of growth, decline, and recovery. It shows that while short-term market movements are unpredictable, long-term trends become surprisingly steady. It explains that investors often misunderstand market swings because they focus too heavily on daily or monthly price changes. These short movements can be wild, emotional, and controlled by crowd behavior rather than real business value. Over longer periods, however, the market displays a much calmer character. Despite crashes, wars, recessions, and political crises, long-term data shows an upward trend driven by economic expansion and growing corporate profits.
The chapter shows that even severe downturns, like the 1929 crash or later slumps, eventually gave way to recovery. These recoveries often surprised investors who had lost confidence during the worst declines.
It stresses that market history demonstrates repeated cycles of optimism and pessimism. Prices swing too high during periods of excitement and too low during times of fear, creating opportunities for disciplined investors. The chapter also introduces the difference between average market returns and emotional expectations. Investors often hope for extraordinary gains, but historical records show that sustainable returns are usually moderate.
It explains that understanding past performance helps investors avoid being misled by temporary booms. Markets that have risen too rapidly often become risky because enthusiasm pushes prices far above real value.
Similarly, periods of heavy pessimism tend to create bargains because prices fall far below what businesses are truly worth. These moments favor patient investors who base decisions on facts rather than moods.
The chapter highlights that no one can reliably predict the market's short-term direction. Forecasts frequently fail because markets react to countless variables that change quickly and unexpectedly.
However, long-term expectations can be guided by studying historical earnings growth, dividend yields, and valuation trends. These fundamentals create a stable foundation for long-range planning. The chapter concludes that the intelligent investor must respect history and use it as a guide, but never assume it will repeat exactly. The goal is to understand patterns, avoid emotional extremes, and remain steady while the market completes its cycles.
Chapter 4, The Defensive Investor. A plan designed for the defensive investor focuses on safety, simplicity, and long-term steadiness rather than aggressive profit-seeking. The defensive investor accepts that time, research effort, and emotional strain must all remain minimal.
The idea begins with the recommendation that funds be divided between high-grade bonds and high-quality stocks. No extreme balance should be chosen. Instead, the range stays between 25% and 75% in either direction depending on conditions. When stocks become overpriced or overly speculative, the safer choice is to increase the bond portion. When stocks fall sharply and fear dominates, raising the stock portion becomes reasonable. A strong emphasis is placed on avoiding risky or fashionable investments. The defensive investor rejects hot tips, aggressive growth stocks, or glamorous companies whose prices rise faster than their true worth. Only large, financially stable companies are suitable, especially those with long records of steady earnings. A consistent dividend history spanning many years signals reliability and disciplined management. Debt levels must remain moderate, and earnings should not show wild swings or repeated declines. Stability becomes a form of protection against unexpected economic shocks. Valuation plays a crucial role. Even the safest company becomes risky when purchased at an excessively high price. The defensive investor pays attention to reasonable price-to-earnings ratios and avoids stocks valued far above their historical norms. A diversified list of such companies reduces the impact of any single mistake. Holding 10 to 30 carefully selected stocks from different industries creates dependable balance over time. Bond choices must be conservative as well. High-grade corporate bonds or government securities are acceptable, but speculative bonds, high-yield temptations, and complex debt instruments should be avoided. Foreign bonds, preferred stocks, and unconventional financial products introduce complications and uncertainties not required by a defensive plan. Simple instruments prove more dependable. The approach highlights discipline over excitement. The investor who follows these guidelines may not experience sudden wealth, but gains a strong defense against loss, emotional errors, and unnecessary risk. The message reinforces that success does not come from predicting markets, chasing trends, or reacting to daily fluctuations. It comes from maintaining a balanced, rational structure that withstands every season of the market. Chapter 5. The Enterprising Investor.
An approach designed for the enterprising investor demands greater involvement, deeper study, and a willingness to look beyond ordinary selections. Instead of relying on broad stability, this approach searches for opportunities that the general public often ignores.
The central idea is to commit effort where most investors are too impatient to look. Companies that are temporarily unpopular, neglected, or misunderstood often carry significant potential when examined carefully.
Sound judgment requires strict rules, not speculation. Opportunities must be chosen because their facts are solid, not because their prices are moving quickly.
Search efforts may focus on companies with low price-to-earnings ratios, low price-to-book values, or strong assets selling at unusually cheap levels. Such mismatches between price and value form the foundation of a disciplined, active strategy.
Another fertile area includes companies recovering from temporary setbacks, businesses whose core strengths remain intact while public sentiment has sharply declined. Patience allows the investor to benefit as conditions normalize.
Bargain issues, particularly those priced below tangible asset value, receive special attention. Purchasing such stocks offers a built-in margin of safety because even partial liquidation may justify the price paid.
This approach insists on deep financial statement analysis. Balance sheets, income reports, and cash flow patterns must be evaluated to confirm true strength. Numbers matter far more than market excitement or trends.
At the same time, the enterprising investor must avoid the temptation of glamorous growth stocks. High expectations often inflate their prices so much that even strong results cannot justify the valuation.
Concentration risk must be controlled. Even when opportunities appear promising, spreading investments across a reasonable number of companies prevents a single mistake from causing significant damage.
Emotional discipline is essential. Quick profits, panic selling, and market predictions all undermine the structured methods required for successful active investing.
The message emphasizes that higher rewards are possible, but only through rational analysis, consistent effort, and strict adherence to value principles. Without these, the enterprising investor becomes no different from a speculator.
Chapter 6. Portfolio Policy for the Enterprising Investor. A policy designed for the enterprising investor expands the search for value beyond ordinary choices, focusing on categories that require patience, analysis, and a willingness to act when others hesitate. This approach aims not for excitement, but for logic-based selections that the market frequently overlooks. One important area includes undervalued common stocks, shares selling far below their earning power or asset value. These issues often appear dull or uninteresting to most people, but their prices offer a favorable margin between cost and true worth.
Another promising group consists of companies with above-average earnings stability, but temporarily depressed prices. Such companies show strong business character despite short-term setbacks that have caused investors to lose confidence.
Certain special situations also attract analytical investors, such as mergers, spin-offs, acquisitions, liquidations, or reorganizations. These scenarios sometimes produce pricing inefficiencies, where the potential reward exceeds the related risk.
However, these opportunities demand thorough study and discipline. Incorrect assumptions, lack of experience, or emotional decision-making can turn a promising special situation into a major loss. The enterprising investor must avoid glamorous, popular stocks whose prices reflect unrealistic expectations. Markets often overpay for companies with impressive growth stories, leaving little safety margin if the future disappoints.
Attention is also given to secondary or smaller companies that receive little attention from the general public. These businesses may provide superior long-term results when their fundamentals are strong and valuations remain low.
No matter which category is explored, price discipline remains essential. Even a fundamentally strong company becomes unsuitable if purchased at an unreasonable price. The difference between value and excitement must always remain clear. A portion of the portfolio may be held in cash or short-term instruments to allow flexibility. This reserve enables quick action when a rare bargain appears, reducing the need to sell existing positions under pressure.
Emotional steadiness separates success from failure. The analytical effort required for this policy is useless if impatience, greed, or fear take control during volatile markets.
The overall message reinforces that superior results are possible, but only when effort, analysis, caution, and rational selection work together. The enterprising path offers rewards, yet demands responsibility, resilience, and a refusal to follow the crowd.
Chapter 7. Investment Funds.
Investment funds are examined as a potential solution for those who want professional management but lack the time or skills to select securities on their own. These funds gather money from many individuals and invest it collectively, promising simplicity and convenience. Despite these benefits, most funds fail to outperform the market over long periods. High expenses, frequent trading, and management errors often reduce results to levels below simple index alternatives. Past performance proves to be a misleading guide. Funds that shine brilliantly in one year often fall behind soon after, revealing how temporary market conditions, not lasting skill, cause their outperformance. Many funds advertise their historical success, but the figures often hide survivorship bias or short periods of luck. Investors who follow these advertisements risk being disappointed when reality fails to match expectations. The cost structure of funds plays a crucial role in future results. Sales loads, advisory fees, administrative charges, and transaction costs silently drain returns over time. Even small percentages compound into substantial losses. The most attractive option for long-term investors becomes the low-cost index fund. Instead of competing with the market, it simply mirrors the market, eliminating the risk of managerial misjudgment and minimizing costs.
The evaluation of fund managers must be realistic and cautious. A manager showing a few years of strong performance should not be assumed skilled unless results extend over a long horizon and through multiple economic cycles.
Investors must also beware of excessive turnover within funds. Constant trading increases taxes and costs while encouraging short-term thinking. Such behavior creates more risk than reward. Diversification across many funds does not guarantee safety either. Holding multiple actively managed funds often results in overlapping positions, higher expenses, and diluted strategies rather than better protection. The message encourages investors to judge funds by simplicity, integrity, and cost efficiency rather than glamour or promises. Low fees, honesty, and steady long-term philosophy matter far more than complicated strategies. The overall guidance emphasizes clear thinking. Funds may serve as tools, but only when chosen with caution and when kept free from emotional decision-making or marketing influence. Chapter 8. The Investor and Market Fluctuations. Investment funds are examined as a potential solution for those who want professional management but lack the time or skills to select securities on their own. These funds gather money from many individuals and invest it collectively, promising simplicity and convenience. Despite these benefits, most funds fail to outperform the market over long periods. High expenses, frequent trading, and management errors often reduce results to levels below simple index alternatives. Past performance proves to be a misleading guide. Funds that shine brilliantly in one year often fall behind soon after, revealing how temporary market conditions, not lasting skill, cause their outperformance. Many funds advertise their historical success, but the figures often hide survivorship bias or short periods of luck. Investors who follow these advertisements risk being disappointed when reality fails to match expectations. The cost structure of funds plays a crucial role in future results. Sales loads, advisory fees, administrative charges, and transaction costs silently drain returns over time. Even small percentages compound into substantial losses. The most attractive option for long-term investors becomes the low-cost index fund. Instead of competing with the market, it simply mirrors the market, eliminating the risk of managerial misjudgment and minimizing costs. The evaluation of fund managers must be realistic and cautious. A manager showing a few years of strong performance should not be assumed skilled unless results extend over a long horizon and through multiple economic cycles. Investors must also beware of excessive turnover within funds. Constant trading increases taxes and costs while encouraging short-term thinking. Such behavior creates more risk than reward. Diversification across many funds does not guarantee safety either.
Holding multiple actively managed funds often results in overlapping positions, higher expenses, and diluted strategies rather than better protection. The message encourages investors to judge funds by simplicity, integrity, and cost efficiency rather than glamour or promises. Low fees, honesty, and steady long-term philosophy matter far more than complicated strategies. Chapter 9. Investing in investment funds. Investment funds promise professional guidance, yet many operate within limits that reduce their effectiveness. Their structure looks strong from the outside, but deeper examination shows weaknesses that often surprise new investors. The idea that experts consistently outperform the market proves unreliable. Many funds struggle to beat even simple, unmanaged market indexes, especially after accounting for their fees. The performance of most funds rises and falls with market moods rather than skilled judgment. When markets soar, funds look brilliant. When markets decline, their success fades instantly, showing how dependent they are on overall conditions. Advertisements often highlight impressive short-term gains, yet these shining numbers rarely continue into future years. Luck is frequently mistaken for expertise. Selection of funds based solely on past results can lead to disappointment. A fund that ranks high today may slip drastically tomorrow, reflecting how unstable performance rankings truly are. Costs remain a silent enemy. Management fees, operating expenses, sales loads, and frequent trading drain the returns that might otherwise reach investors. Even well-run funds lose their advantage if they trade too aggressively. High turnover creates friction. Tax costs, commission expenses, and emotional decision-making, all reducing long-term gains. Diversifying across many managed funds does not guarantee safety. Overlap among holdings often leads to the same stocks being purchased again and again, worsening costs without increasing protection. Low-cost index funds quietly outperform a majority of active funds. Their strength lies not in predicting markets, but in avoiding the common mistakes made by fund managers. Honesty and simplicity become more valuable than flashy strategies. A fund that charges little, trades modestly, and maintains a long-term focus offers better odds than one filled with complexity and promises. The message encourages treating investment funds as tools that must be chosen with precision, not emotion. A calm, rational evaluation protects against the traps set by marketing, short-term noise, and unrealistic expectations. Chapter 10. Investor and Advisors. Advisors are often called guides in the world of money, yet many carry lanterns that shine only halfway. Some offer clarity, others offer noise, and it becomes difficult to separate wisdom from mere confidence. The world seeks predictions, but predictions rarely honor their promises. No advisor can see the path of the market with unbroken certainty, no matter how polished their words or charts may appear. Opinions sold as guarantees become dangerous. When guidance turns into prophecy, risk becomes disguised as certainty, and investors mistake confidence for truth. Practical advisors focus not on forecasting, but on strengthening discipline. Their true value lies in helping investors remain rational when emotions run wild. A wise advisor encourages caution when excitement grows too loud, and confidence when fear steals the courage to act. Their strength is not prediction, but balance. Many investors look for magic solutions, searching for someone who can remove uncertainty entirely. Yet the market offers no shortcuts. Only methods, patience, and judgment can soften its storms. Advisors must be chosen with the same care used in selecting investments. Integrity matters more than brilliance, and long-term steadiness outweighs momentary success. Honest advisors admit the limits of their knowledge. They protect clients from illusions instead of feeding them. They help manage behavior, expectations, and discipline more than they manage market forecasts. The greatest service an advisor can provide is emotional armor.
When markets roar with euphoria or tremble with panic, the advisor becomes a steadying force, reminding investors that value exists beyond the moment's noise. Advisors who charge fair fees and respect the investor's goals become allies. Those who sell dreams, rush transactions, or chase trends become hazards. Chapter 11. Security Analysis General Approach. In the Scrolls of Financial Understanding, the study of a security begins with quiet observation, as a sage studies the patterns of wind and stone. Value reveals itself not through noise, but through patient examination of what a company truly holds and earns. The first mark of wisdom lies in knowing the difference between appearance and substance. Prices may dance wildly, but the essence of a business remains carved in its earnings, assets, and stability. Study begins with the strength of the enterprise, the balance of what it owns and what it owes. A structure built on solid assets stands firm even when storms shake the marketplace. Earnings must be examined not in isolation, but across many seasons. A single year of fortune teaches little. Many years together reveal truth. Beware the illusion of rapid growth. Swift rising numbers may dazzle the untrained eye, but wisdom asks whether such brilliance can endure the turning of cycles. The scroll warns against paying too high a tribute for any business, no matter how noble its standing. When the price rises beyond reason, even the strongest enterprise becomes a fragile bargain. True assessment honors both facts and caution. Numbers must be examined with clear eyes, unclouded by hope or fear. When the figures whisper uncertainty, further reflection is required before action is taken. There is virtue in choosing only those enterprises whose worth is greater than the price demanded. Such choices bring protection, like a warrior's shield forged from tempered iron. And there is wisdom in accepting that no calculation is perfect. Even the most disciplined judgment benefits from a margin of safety, a sacred buffer between assumption and reality. The scroll closes with a reminder written in calm ink. To understand a security is to see its essence, separate from the market's ever-shifting shadows. To act with discernment is to walk the path of resilience and clarity. Chapter 12. Security Analysis for the Lay Investor. In the quiet realm where numbers whisper and markets breathe like living spirits, the study of a company becomes an act of listening. Value does not shout. It reveals itself like a hidden constellation waiting for the patient observer. The path begins with the simplest sacred signs, earnings that move like a steady river, flowing year after year without violent storms or sudden droughts. The next sign lies in the balance between what a company owns and what it owes. When the scales tilt gently and harmoniously, resilience is born. When they tremble, risk awakens. Dividends appear as ancient offerings, tokens of reliability left behind through decades of uncertainty. When these offerings remain unbroken, they speak of discipline older than market cycles. The mystical scroll warns against the illusion of dazzling growth. Some stars burn bright but die young, leaving nothing but echoes. Enduring light belongs to those who glow steadily, not violently. Valuation is treated like reading sacred runes. When the price rises far above the rune's meaning, danger hides beneath the beauty. When the price rests humbly below the truth, opportunity opens like a forgotten gate. The Scroll of Understanding teaches that simple ratios, PE, PB, and earning strength, are not mere numbers, but symbols guiding seekers toward clarity. Complexity, noise, and hype are illusions woven by restless spirits of speculation. They cloud the vision, turning wisdom into confusion and confidence into guesswork. The mystical teaching reminds that perfection is unattainable. Even the most precise analysis holds uncertainty, and therefore protection must be placed between assumption and action. This protection becomes the margin of safety, a sacred shield forged from humility. Chapter 13. Comparison of four listed companies. In the kingdom of commerce, four mighty houses stood before the council of investors, each adorned with armor forged from profits, assets, and reputations built over generations. They appeared strong, but their true worth could only be revealed through the ancient art of comparison.
The first house shone with brilliant renown, praised by bards and merchants alike. Yet beneath its golden crest lay a troubling truth. Its price in the market had risen beyond reason, inflated by admiration rather than substance.
The second house stood strong and steady, built on solid foundations and predictable earnings. Its virtues were real, but its value was often overlooked because it lacked glamour.
The third house, once wounded by past troubles, had begun to heal. Its profits returned slowly, like a warrior rising after a long battle. Yet the market still doubted its strength, leaving its price modest despite improving fortunes.
The fourth house was frail, its walls weakened by years of inconsistent earnings, yet the market, driven by old memories of past glory, still placed a high price upon it, unaware that its foundation no longer matched its legend.
The council studied these houses not through myths or the chants of speculators, but through the quiet truth of numbers. It became clear that reputation alone could not determine worth, nor fear alone determine weakness.
The lesson emerged like a sword drawn from its sheath. The finest investment is not always the house with the brightest armor, but the one whose price stands far beneath its true power.
The council discovered that a modest house with fair price could offer greater reward than a magnificent house priced far beyond its worth. Splendor was not enough. Only value mattered.
In this medieval realm of markets, judgment required discipline. Compare strengths, expose weaknesses, measure price against truth, seek bargains hidden behind shadows of neglect.
Thus, the council concluded, greatness in business does not guarantee greatness in investment. Only when price bows before value does the investor find victory.
The city was a maze of numbers, shadows, and whispered deals. Somewhere in that fog lay the truth about which stocks a cautious investor could trust. The rules weren't glamorous, but they kept people alive in a market that chewed up the reckless.
The first clue pointed to size. Big firms with long histories, companies too sturdy to vanish overnight. Smaller players made too much noise and evaporated the moment trouble came knocking. Financial strength was the next lead. Clean balance sheets, low debt, and solid liquidity created a sense of safety rare in the market's underbelly. A record of steady earnings became the third badge of credibility. Not flashy spikes or dramatic falls, just quiet consistency through thick and thin, year after dusty year. Then came dividends, those small but reliable cash signals. Only firms that had paid them for decades without fail earned a place on the detectives' list of trustworthy suspects. The investigation took a darker turn with valuation. A stock priced too high was like a witness who talked too smooth, too risky to believe. A reasonable price-to-earnings ratio meant the story matched the facts. Book value added another layer to the case. Paying far above what a company's assets were worth felt like trusting a crook with no alibi. The final formula, PE multiplied by PB, had to fall under a strict limit. Anything higher meant the risk was too great, the shadows too long, the case too murky. The safe list was built not from optimism, but from hard logic. No hype, no rumors. Just companies with proven records, fair prices, and the backbone to survive the market's darkest nights. In the end, the rules worked like a trench coat in the rain, simple, reliable, and built to protect. Those who followed them didn't just find good stocks, they avoided the bad ones lurking in the shadows. Chapter 15. Stock Selection for the Enterprising Investor. Across the star systems of the Galactic Exchange, investors searched for rare signals, stocks so deeply undervalued that they glowed faintly in the cosmic darkness. These were not ordinary opportunities. They were anomalies, gravitational distortions in the fabric of price and value.
The mission began with a category known as bargain worlds, companies priced far below the true strength of their assets. On scanners, they appeared like planets rich in resources, yet abandoned by the traders of the universe. Some of these planets housed civilizations capable of recovering after temporary collapse. Their earnings flickered like damaged star cores beginning to pulse again, promising rebirth. Other opportunities drifted in the form of special cosmic events, mergers of planetary empires, breakaway moons, liquidation comets, and reorganizing star clusters. These phenomena disrupted prices, revealing hidden corridors to profit for those who dared chart them. But the universe held dangers too. Radiant growth planets shone brilliantly, drawing inexperienced travelers toward their blinding light. Yet beneath their surface, the energy was unstable, overheating, unpredictable, and waiting to explode. To navigate safely, explorers relied on the cosmic criteria, ancient formulas etched into databanks across the galaxy. Low price-to-earnings ratios indicated gravitational stability. Low price-to-book values revealed solid planetary foundations. Secondary planets, small, overlooked, floating silently in remote quadrants, often carried the greatest potential. With strong fundamentals and minimal attention from interstellar traders, they offered hidden treasures waiting to be claimed. Yet even in this galaxy, danger followed the careless. Buying too soon or too late could send travelers spiraling into black holes of loss. Timing required discipline, selection required logic, action required courage. The most powerful weapon in this universe was not speed or aggression, it was patience. A well-timed entry into a discounted star system could yield riches far greater than chasing meteors of temporary excitement. And so the explorers of value moved through the galaxy, avoiding radiant illusions, seeking quiet opportunities, and anchoring every decision in the gravitational truth of intrinsic worth. Their success was not built on cosmic luck, but on cosmic discipline, knowing that the universe rewards those who follow the laws of value, not the chaos of speculation.